Hey everyone, welcome back. Today we're diving deep into behavioral biases and how they can really mess with our investment decisions. You sent over this article that breaks it down so well, and I think we can all learn a thing or two from it.
You know what's so interesting? This article connects these biases to some major historical events like the dot-com bubble and even the 2008 financial crisis. It really hits home that these aren't just, some theoretical concepts. They have some real-world consequences.
For sure, it's a little unsettling to think about how even experienced investors, they can fall prey to these biases.
Hmm.
I mean, the article said that 60% of investors admit that their emotions, they actually influence their financial choices. That's huge. So let's break it down. What exactly are these behavioral biases and how do they actually impact the way we make investment decisions?
Well, behavioral biases are basically mental shortcuts that our brains use to kind of simplify decision making.
Okay, so it's like our
Yeah.
brains are trying to work smarter, not harder.
Exactly. And, in a lot of areas of life, these shortcuts, they can be super helpful. But when it comes to investing, they can lead to, well, irrational choices that may not actually be in our best interests.
So it's like our brains are trying to be efficient, but that efficiency sometimes comes with a cost.
You got it. And that's actually where this whole field of behavioral finance comes in. It basically combines psychology and finance to understand why we make, let's say, less than optimal decisions.
Can you give us some real-world examples of how these biases have played out, in actual situations?
Absolutely. Let's take the dot-com bubble, for
Oh,
instance.
yeah, that's a big one.
Right. A lot of investors got caught up in all the hype around internet companies back then. They were driven by, this fear of missing out and this, well, kind of excessive confidence in the future of technology. This led to what we call a classic case of herding behavior.
Hurting. So like everyone was just following the crowd.
Precisely.
Yeah.
People were pouring money into the market without really doing their due diligence.
So it's like everyone was jumping on the bandwagon, even if they didn't really understand what they were investing in.
Exactly. And we all know how that story ended. The bubble burst, and a lot of investors, they experienced pretty devastating losses.
Yeah, that's a tough lesson to learn. It's a stark reminder that emotions, they can really cloud our judgment, even when it comes to something as important as our investments.
What about the 2008 financial crisis? Did behavioral biases have a role to play there as well?
Definitely. In fact, confirmation bias was a major factor in that crisis.
Confirmation bias. Remind me what that is again?
Confirmation bias is basically when we uh, seek out information that just confirms what we already believe, even if it means ignoring warning signs that are right in front of us.
So even when there's evidence that contradicts our beliefs, we sometimes just choose to ignore it.
It's easier to believe what makes us feel comfortable, right? Yeah.
Yeah, and that's precisely the danger of confirmation bias. It can lead us to make decisions based on, well, a bit of a skewed perception of reality. A lot of investors, during the 2008 crisis, they kind of looked for information that supported their belief that the housing market, it was stable. They didn't really pay attention to the warning signs that, things might not be as rosy as they seemed.
So basically, they were in denial.
Yeah, sort of.
It's pretty scary to realize how vulnerable we are to these biases. Is there anything we can do to protect ourselves? What are some strategies we can use to kind of overcome these mental pitfalls?
Well, the good news is there are some proven strategies to kind of mitigate the influence of these biases. The article outlines several key approaches. One of the most important is establishing a disciplined investment process.
Okay, so what exactly does a disciplined investment process look like?
It all starts with defining your investment goals.
Like, what are you actually trying to achieve with your investments?
Precisely. What are you saving for? What's your risk tolerance? What's your time frame? Once you have those answers, you can start developing a strategic asset allocation plan. This basically outlines how you're going to diversify your portfolio across different asset classes.
So stocks, bonds, real estate, that sort of thing.
Exactly. And it's important to have a plan and, try to stick to it instead of reacting emotionally to all the ups and downs of the market.
Right. So it's like having a roadmap and not getting sidetracked by detours.
Exactly. And don't underestimate the power of writing down your investment decisions and the rules you've set for yourself. This can really help remove that emotional impulsivity from the equation.
Okay, so almost like setting boundaries for your investments.
That's a good way to put it.
What are some other strategies we can use to combat these biases?
Another key strategy is relying on data and analysis. Don't make decisions solely on gut feelings or, what you hear on the news. Take the time to research your potential investments. Use quantitative models, fundamental analysis to evaluate their true worth.
So do your homework.
Exactly. And remember, emotions, they can cloud your judgment even when you think you're being completely objective. So developing emotional intelligence is really crucial. Be more aware of how you're feeling and how your emotions might be influencing your choices.
It's like having self-awareness for your money.
Exactly. You might also want to think about using automation. Platforms and tools that execute trades based on preset rules can be incredibly helpful. It takes the emotion out of it, especially when it comes to things like rebalancing your portfolio.
So it's kind of like putting your investments on autopilot, guided by logic, not by feelings.
Yeah, that's a good way to think about it. And finally, remember that this is an ongoing process. Review, learn, and adapt. Regularly assess how your investments are doing and try to identify any instances where those pesky behavioral biases might have played a role. Learn from those experiences and refine your strategies accordingly.
It's like a continuous loop of learning and growing as an investor. This is all great stuff. But even with the best of intentions, we're still human. What are some specific traps we should watch out for, and how can we avoid them?
Well, let's delve into some common challenges. One that a lot of people fall prey to is overconfidence bias. This is where you basically overestimate your skills and knowledge, which can lead to taking on too much risk.
Oh, I know that one all too well. Remember that time I thought I could, time the market perfectly and ended up buying high and selling low?
Uh-huh, we've all been there.
Yeah, not my finest moment as an investor.
The key here is to seek out diverse perspectives, and really challenge your own assumptions. Don't be afraid to ask for feedback and consider viewpoints that are different from your own.
Almost like getting a second opinion before making a big financial decision.
Exactly.
Okay, what about confirmation bias? The article mentioned that one as
Oh,
well.
yeah, confirmation bias, that's a sneaky one. It's that tendency to favor information that just, well, confirms your existing beliefs, even if it means ignoring evidence to the contrary. It can lead to a really unbalanced portfolio.
It's like only reading news articles that support your political views, even if they're completely one-sided.
That's a great analogy. To combat this, you need to deliberately seek out contradictory evidence. Force yourself to consider different viewpoints, even if they make you uncomfortable.
So play devil's advocate with yourselves.
Exactly.
Now, what about loss aversion? I think that's something a lot of investors really struggle with.
You're absolutely right. Loss aversion is a powerful bias. It's the tendency to feel the pain of a loss much more strongly than the pleasure of an equal gain.
Yeah, that makes sense. It's like holding onto that old sweater you never wear just because you don't want to admit you wasted money on it.
Exactly. And this can make it really hard to sell assets, even when it makes sense strategically to, rebalance your portfolio. The article suggests focusing on the long term and avoiding those impulsive decisions based on short-term market movements. You might want to consider using stop-loss orders. They basically automatically sell an asset when it drops to a certain price.
So it's like setting a safety net.
Yeah, exactly. It takes the emotion out of those tough sell decisions.
Makes sense. Okay, what about herding? Isn't that just following the crowd?
Yeah, that's it. Herding is basically making investment decisions based on what everyone else is doing, even if it goes against your own analysis.
Right, like the whole dot-com bubble situation.
Exactly. Not a good strategy.
So how do we avoid getting caught up in that?
Trust your research. Stick to your investment plan, even when it seems like everyone else is going in a different direction.
So it's okay to be a contrarian.
Exactly. If your analysis supports it, absolutely.
Got it. Okay, what about anchoring bias? I'm not as familiar with that one.
Anchoring bias is when you rely too much on the first piece of information you get, even if it's not relevant or outdated.
So, like judging a book by its cover.
Kind of. To avoid this, gather information from various sources and don't get fixated on just one data point.
Okay, don't get stuck on first impressions.
Exactly.
We've covered a lot of ground here. Are there any other big biases we should be aware of?
There's also recency bias. That's when we put too much emphasis on recent events when we're trying to, predict what's going to happen in the future.
Yeah, I've totally been guilty of that one. It's so easy to get caught up in those latest headlines and forget to look at the bigger picture.
Exactly. The solution is to take a step back and consider the long-term historical data. Try to avoid being swayed by those day-to-day fluctuations.
So basically, don't get too caught up in the daily drama. Look at those long-term trends instead.
Makes sense. This has been so insightful. I feel like I'm already starting to see these biases at play, in my own thinking. The article also mentioned getting advice as a potential solution to some of these biases. What are your thoughts on that?
You're right. Having another set of eyes on your situation, it can be really helpful, to spot those biases you might not even realize you have.
So it's not just about picking the right stocks or bonds. It's also about understanding our own psychology as investors. Exactly. And
Hmm?
that's really the heart of behavioral finance. It's about bridging that gap between what we logically know we should be doing and what we actually end up doing.
Yeah. And I think the article made a great point about awareness being that first step.
Yeah.
Once you can identify those biases that are tripping you up, you're already halfway to overcoming them.
Couldn't agree more. Once you know your weaknesses, you can start to develop strategies to kind of counteract them.
And that's where those solutions we discussed come in. Having a disciplined process, focusing on data, and even using tools like robo-advisors.
Exactly. It's all about having a toolbox of strategies that work for you. The article also delved into some industry trends related to, behavioral finance.
Yes. We talked about robo-advisors,
Mm.
those automated platforms that manage investments and, try to minimize those emotional biases. What are your thoughts on that trend?
Well, robo-advisors can be great for investors who want a more hands-off approach, or those who are worried about their emotions getting in the way. They can help with things like portfolio diversification and rebalancing, which can really take some of that guesswork out of investing.
It's like having a personal AI assistant for your money. What other trends are you seeing out there?
Another interesting development is the use of what we call behavioral nudges. These are subtle interventions designed to kind of encourage, well, better financial decision making.
Can you give me an example of a nudge?
Sure. Think about automatic enrollment in retirement savings plans. By making that the default option, well, more people end up saving for retirement without having to actively opt in.
So you're making it easier for people to do the right thing.
Exactly. And it's a simple change that can have a huge impact over time.
I love that. What else is new in the world of behavioral finance?
We're also seeing a lot of advancements in data analytics. This data is being used to better understand investor behavior and identify potential biases. This information can really help advisors tailor their advice to, better address specific challenges.
So we're using data to outsmart our own brains. That's pretty cool.
Yeah.
The article also mentioned a company called Forbes LeBrock. What's their connection to all of this?
Well, Forbes LeBrock, while they're not financial advisors themselves, they play a really interesting role in helping investors tackle these behavioral biases. They specialize in what's called strategic liquidity. It's basically asset-based lending that allows investors to rebalance their portfolios without actually selling their assets.
That sounds interesting. Can you explain how that works? I'm not sure I understand how, lending money can actually help with diversification.
Okay, imagine you have an investor who has a lot of their money in, let's say, tech stocks. They realize they need to diversify, but, they're a little hesitant to sell those stocks. Maybe they're emotionally attached or worried about missing out on future gains.
Okay, I can see that happening. So how does Forbes LeBrock fit into this?
Well, Forbes LeBrock can step in and provide an asset-backed loan using those tech stocks as collateral. This gives the investor that liquidity they need to invest in other asset classes without having to actually sell their tech holdings. Then they can use those loan proceeds to, diversify their portfolio and reduce their overall risk.
So it's like a bridge loan for your investments. It lets you make those smart moves without having to touch your long-term holdings.
That's a great way to put it. And this approach directly addresses several of those biases we've talked about. It helps with loss aversion, right? Because you get to keep your assets. It facilitates, making strategic decisions by providing that liquidity to diversify. And it lets investors stay in control of their portfolios without feeling pressured to make those emotional selling decisions.
That's pretty incredible. It's like a safety net for your investments.
Yeah.
It helps you make those smart, rational choices even when your emotions are telling you to do something else.
Yeah. Precisely. Forbes LeBrock offers a really valuable tool for investors who want to overcome those behavioral biases and ultimately achieve those long-term financial goals.
This has been incredibly insightful. I feel like I've learned so much about how our minds work, especially when it comes to money, and how we can kind of stay on track. One thing we haven't really talked about is the difference between cognitive biases and behavioral biases. The article mentioned it briefly. I think it would be helpful to clarify that.
You're right. It's a subtle distinction, but it's important. Cognitive biases are basically patterns of thinking, those mental shortcuts that can lead to errors in judgment. It's how our brains process information. Behavioral biases, they're more about the outcome of those thought processes. They're the actions we take because of those cognitive biases.
Okay, I think I'm starting to see the difference. Can you give us a real-world example?
Sure, let's go back to confirmation bias. The cognitive bias is that tendency to seek out information that just reinforces what we already believe. The behavioral bias might be, holding on to that losing investment because we're only paying attention to the positive news and ignoring those warning signs.
So the cognitive bias is kind of the thought process, and the behavioral bias is the action we take because of that thought process.
That's a perfect way to put it. And when we understand both the cognitive and the behavioral aspects of these biases, well, we can be much more effective at, minimizing their impact on our decisions.
Absolutely. This has been an eye-opening deep dive into the world of behavioral biases. Before we go, can you give our listeners a quick recap of the key takeaways?
Sure, it all starts with recognizing that these biases exist. We all have them, and they can have a huge impact on our financial decisions. Having a disciplined investment process, clear goals, a plan for your asset allocation, regular rebalancing, those can all help us stay the course and avoid making impulsive choices. And finally, remember there are tools out there to help. Things like behavioral coaching, robo-advisors, and even innovative solutions like those offered by Forbes LeBrock.
Great points. And I think the big takeaway for me is that we don't have to be controlled by these biases. By understanding them, we can take control and make smarter, more rational decisions.
Absolutely.
Well, that brings us to the end of our deep dive. A huge thank you to you for sharing your expertise with us today. It's been fantastic learning from you.
Thank you for having me.
And to all of you listening, we hope you found this deep dive into behavioral biases valuable. Remember, awareness is key. Now, as you go about your day, we'll leave you with this question. What one small change can you make today to counteract a bias that might be holding you back? Think about it, and let's keep this conversation going. Thanks for joining us.
Yeah, I think a really important thing to remember is that this is an ongoing thing. You're
Yeah.
never going to be totally immune to these
So it's like a
biases.
journey, not a destination.
Yeah, exactly. The more we learn about how our minds work, the better we'll be at making good financial decisions.
Well, I think you've given us a lot to think about and a lot to work with. Thank you so much for sharing your expertise with us today. This has been really great.
My pleasure. Really enjoyed it.
And to everyone listening, we hope this deep dive has been valuable. Remember, the first step is awareness, right? So as you go about your day, we'll leave you with this. What's one small change you can make today to, counteract one of those biases that might be holding you back? Think about it and, to keep the conversation going. Thanks for joining us.